What's up, family? This is your boy Ivan Hall, the Credit King. Are you trying to buy a new car? Here are a few tips that will serve you well. One of the biggest mistakes people make when buying a new car is forgetting to include the cost of auto financing in the total price. For example, let's say you talk the dealer into taking $2,000 off of the sticker price. Awesome work! However, capitalizing on your excitement, the dealer talks you into putting $0 down and stretching your car loan term from 3 to 4 years to keep monthly payments low. That might sound great on paper, but in reality, you'll end up paying $3,000 more in interest alone. If you're willing to negotiate the price of the car, you shouldn't ignore the rates and terms of your car financing. If you're in the market for a new car, don't wait until you're in the offices where you finish the paperwork to think about your financing. The first step to securing an ideal car loan is to check your credit report and score. Dealerships will often advertise very good interest rates on new cars. What they leave in the fine print is that these rates are only available to car buyers with the best credit. Dealers and banks will still give you a car loan if you have a poor credit score. That's because they know they'll make tons of interest off of you, and if you don't pay, they can just repossess it. Buyers with credit scores in the low 700s can still get a lower interest rate but may not qualify for the best promotions. After that, rates rise quickly. If you're a borrower with a below-average credit score, under 650, you may be presented with car loan rates of 10% or more. The lower your credit score, the more important it becomes to shop around and make sure you're getting the best rate a bank can offer you. Yes, you may have to pay more than someone with a superior credit score, but you may not have to pay the first rate somebody offers. If you have an excellent credit score, 750 plus, you can usually get the best financing rates right from the dealership. This is because the dealer themselves will serve as a broker and show those with good credit the best options across multiple lenders competing for your high credit patronage. The tables are completely turned when you have a poor credit history, though. You're the one the dealer will take advantage of, and you certainly won't qualify for anything near good when it comes to rates. Regardless of your credit score, a dealer will always try to sell you low monthly payments, zero down, and long car loan terms of 4, 5, or even 6 years. This is the opposite of what you want. Lower monthly payments are a manipulative and old-as-dirt sales tactic. Dealers like them because they make it seem like you can afford more cars than you really can. They make it seem like you're getting a deal, when you're actually getting screwed. They create breathing room to sell you extras. They confuse buyers and pacify negotiations. They please their lenders since they'll make gobs of interest off of you. Suddenly a $470 car payment becomes a $350 car payment. And yet, you're not paying any less for the car. In fact, you'll be paying much more in interest. The longer you take to repay a car loan, the more interest you'll pay. But that's not all. Many times banks will charge higher interest rates for longer loans, further increasing your cost of credit. It's tempting to stretch out an auto loan over 5 or even 6 years to get to a more comfortable monthly payment, but this means you'll pay a lot more in interest and almost certainly be upside down on your car for nearly the life of the loan. In addition to shortening the term of the auto loan, you also want to minimize the principal. The principal of the loan is the total amount you borrow, and thus have to pay interest on. When a dealer offers you a loan with zero down payment, they're basically saying, let's maximize your principal so that my lender can charge you more interest. Don't do it. Place at least 20% down on your new car so that you can reduce your principal and thus the total amount of interest you'll end up paying. If you can't afford to place 20% down on the car you're eyeing, chances are that you probably can't afford the monthly payments plus interest over the course of the auto loan. Pay for sales tax, fees, and extras with cash. Exhausted by your shrewd negotiations and preparedness, the dealer may still try to roll miscellaneous expenses into your financing options. These may include their dealer fees, $800, taxes, 7% minus 10%, extended warranties, and the cost of optional extras. Asking for an itemized invoice for all of these expenses, and paying cash, ensures a few things. The dealer will have a harder time hiding BS fees from you. You won't pay for extras that you don't truly want/need. You won't pay $1,000 in additional interest. When negotiating, always ask for the out-the-door price. This is code for the bottom line, no-nonsense price of the vehicle. Then discuss finance terms. Don't fall for the gap insurance speech. Gap insurance is something car dealers and lenders sell you, to cover the gap between what an insurance company thinks your car is worth, and what you owe on your car loan, in the event you're in an accident and the insurer declares the car a total loss. The thing is, if you structure your auto loan properly with a 20% down payment and a short, 3-year term, you shouldn't need gap insurance. With good loan terms, there should never be a scenario where you owe more than the car is worth. So if your dealer is really pushing you for gap insurance, that might be a sign that your loan terms need reevaluating. For more credit tips, credit hacks, and credit repair secrets, subscribe to our YouTube channel and visit us online.